Well, good morning. I'm Jagender Rana. The topic for the discussion today is InsurTech Potential. InsurTech Potential. With the advent of new technology and some alternate enhancement factors, the insurance industry shows promising growth. All the processes have been taken online has led to increase in operational efficiency of insurance companies. The incumbents have started adapting to new ways of customer engagement through NBFCs, bank assurance, online web portals, and InsurTech. But along with a promising future, there are a lot of challenges that these incumbents face. The majority of life insurance policies are sold in the last quarter, which gives an irregularity in the sales pattern. Insurance is also merely perceived as a tax-saving instrument. So this sentiment in the minds of the consumers has been a barrier to the sales of insurance policies. The strategies for distribution channels have also never been quite impressive, cited by poor data collection and management. The rural insurance sector is highly untapped by private players. The microinsurance industry shows high potential in the rural area. The insurance companies, apart from LIC, do not show any interest in such areas, thereby neglecting the establishment of any satellite branches. The lack of literacy in terms of insurance also plays a major role in not letting people purchase insurance policies. On the foundation, some do not know of such schemes, while some others lie on the below poverty line, where the basic necessities like food, clothing, and shelter themselves are not fulfilled. So there has been an apparent drop in persistency ratio as well. Persistency ratio is defined as the percentage of all existing policies that are renewed by the insurers annually. So the persistency ratio for 1 year has been as low as 61%. This means that out of 100 policies purchased in a year, only 61 of them were renewed in the following year. So this ill phenomenon leads to high cost for the insurance players in the market as well as for the customers, since the amount of premium paid in the first year is higher than that in the following years. The drop in the persistency ratio has been attributed to the lack of communication of insurers with customers regarding the renewal of policies. Insurance penetration, the ratio of annual gross insurance premium to the gross domestic product, is around 3.4% as compared to the global average of 6.2%. Insurance companies in India not only provide risk cover for various objectives, but in some cases they give some additional benefits as well, as, for example, a source of long-term debt and equity for infrastructure projects. The Insurance Regulatory and Development Authority of India regulations requires insurance companies to invest more than 15% of their funds in infrastructure and social sector. Yet 80% of Indian population is without life insurance cover, subjecting themselves to weak social security and no old age income. However, the advent of InsurTech might be able to trigger these weak spots and lead to the overall development of the whole sector. InsurTech, as a subject of FinTech, refers to several segments of the new technologies that are disrupting the insurance sector through smartphone apps, claim acceleration tools, consumer activity, wearables, individual consumer risks, development system, automated compliance processing, and online policy handling. So the InsurTech has been broadly categorized by Crunchbase Insights into 8 categories, namely healthcare, automobile, property and casualty insurance, life insurance, peer-to-peer insurance, small business, insurance software, product insurance, mobile insurance. InsurTech follows a different approach as compared to what the incumbents do. InsurTech considers auto insurance as cash cows, since the insurance are recurring in nature and their pricing depends on car characteristics and the experience of the driver. These cash cows can provide finances to the InsurTech startups to chase customers differently than how the incumbents do it. Although InsurTechs are smaller and younger companies, they try to target a new base of customers which are at the bottom of the pyramid, whereas the incumbents are managing the existing customers. So the incumbents also tend to provide simple functionalities through their products, whereas the InsurTechs try to avoid competition from incumbents by competing in a different sector altogether. Insurance companies do not innovate and try to focus on existing business models. On the other hand, InsurTechs innovate and try to gauge future consumer needs, and this gives them additional leverage to become powerful in the future. So InsurTechs initially are smaller in size and hence have very little to lose, whereas for the incumbents it is a trade-off between innovation and the current operation of the business. InsurTechs are also trying to take the customer experience to phygital, which is a mixture of physical and digital. So examples of phygital medium can be a video calling session, which is partly physical and partly digital. India shows huge market potential for insurance industry owing to the demographic dividend. The average Indian age by 2020, average Indian age at the 2020 is 29 years as against 40 years in the US, 46 years in Europe, 47 years and in Japan. So even as the labor force declined by 4% in industrialized world and by 5% in China in 20 years, it could increase by 32% in India. So insurance companies and InsurTechs have also tried and tested a number of distribution channels. A number of distribution channels have been discussed below, like channel agencies. Insurance agents have deeper networks to penetrate the retail and SME businesses, and they have a better understanding of the minute detail of the products. But agents as a distribution channel generally yield lower margins and are not perceived to be profitable by the companies. Then channel in-house. Such a distribution channel provides a front-end advantage to companies, since the employees and internal agents have a better understanding of the product that an external agents would have. One of the limitations of internal agents is the lack of penetration into the rural areas and the lack of understanding of the ecosystem and cultural norms of consumers at the bottom end of the pyramid. Then channel brokers. A broker would have an expertise in attracting commercial consumers and can also deliver complex products with a wider reach in the commercial space. So the brokers are held back by the limitations in growth rates of commercial products. Also, the commissions for brokers are highly negotiated due to the advent of the virtual selling channels. This puts a cap on the profitability of the brokers as individuals. So, channel bank assurance. Insurance companies scope the clients to the banks in order to cover a wide array of clients that would be interested in integrating insurance products in their portfolio. However, the bank tellers might not understand the intricacies of the insurance products, and or hence the quality of service provided by the bank tellers might be compromised. So, channel referral system. The expansion of consumer base depends solely on the quick reach to end by the customers among themselves. This helps the insurance companies avoid the sensitivity involved in sharing the databases with other channels. Such distribution channels are held back because of absence of volume obtained by referral systems, and hence such a distribution channel depends solely on the consumers with minimal investment. InsurTech has attracted negative criticism as well. In some of the developed economies like Australia, InsurTech has given rise to a number of fraudulent practices. This highlighted the need for regulations in the insurance market. InsurTechs have also not proved to reduce the operating cost either on the absolute basis or percentage of gross revenue from sales. Some early words have adopted technology in the business, while the other ones are merely following suit. So this is leading to the development of same type of technology, and there is no differentiation to become a unique selling point for insurance companies. So the investors are more confident about the fintechs rather than the InsurTech startups. This makes the fintech companies grow exponentially faster than the InsurTech startups. InsurTech has not yet solved the industry problems of unpaid claims, advisors' fee, declining profitability, and low consumer trust. Also, because of the established IT system, the insurance companies are not yet ready to replace them by new technological advancements. The InsurTech startups till now have largely tried to use technology and digital solutions in the supply side vertical. Some of the untapped insurance-specific verticals are the reasons that the InsurTech startups have not been able to attract investments to a larger magnitude. So, according to the study conducted by the Oliver Wyman, the three segments that can be largely tapped from the insurance industry perspectives are the proposition segment, the distribution segment, and the InsurTechs have also done fairly well in the operation segment. So the next phase in these segments would be to step up and make the processes more efficient and consistent such that they would help companies in the insurance sector produce long-term sustainable profits. InsurTech tools, as far as InsurTech tools are concerned, the insurance industry is about to go a long way with an amplification in the operational efficiencies guided by technology and other trends. Some of the recent trends that have been seen in the insurance industry are smart contracts. A smart contract is a computer protocol intended to digitally facilitate, verify or enforce the negotiation or performance of a contract. A smart contract works on blockchain technology for transparent and flexible claims management. Then telematics. Telematics is the branch of information technology which deals with the long distance transmission of computerized information. Telematics is completely used by insurers to study the driving pattern of customers. On the basis of the study patterns, the insurers give a rating that eventually determines the customer's premium. Then wearables. Wearables are smart electronic devices that can be incorporated into clothing. So future of InsurTech seems to be bright because the Indian insurance landscape has not embraced technology yet. The reason for being the hesitant towards technology is that the insurance incumbents do not have confidence in the continuity of the startups, and hence investing in startups becomes a dicey job for incumbents as well as investors. Another concern is the security of data. A number of cases have occurred in India where the data is accumulated from the consumers and then sold to third parties at cheaper prices. This has also led to the mistrust between the consumers before sharing personal data and with any company. So insurance companies should also target the bottom level of the wealthy pyramid. The rural areas of India have been hardly chartered. The rural insurance market shows huge potential and customer base to tap. It has dedicated a CAGR of double digit since the last couple of years, and this shows an enormous growth potential. Thank you.